Hi everyone, hope you're all doing well, and today we're going to talk about 5 undervalued stocks that you might want to consider with a new year coming up. These might be 5 new additions that you might want to consider into a portfolio. I'm actually considering doing like a UK version as well, like 3 undervalued UK stocks that I don't own. On this list I actually do own one of them, but the rest I don't own, and the rest of them I actually don't talk about too much on the channel either. So yeah, I wanted to just give you guys some like new stocks that I have never talked about, some stocks that have been sold off recently, and yeah, decent prices that you might want to consider for 2022. So we're going to do the 5 today. Like I said, there's only one that I own, and I don't know if you guys want to see a UK version of this, but let me know. So we'll get started onto these stocks in particular that I want to talk about. Some of them I'm really interested in myself. So this one in particular has really caught my eye, especially after this week. So number one is going to be a company called Micron Technologies. So now these guys do actually produce semiconductors, and a lot of these stocks have been really hot this year. If you look at the likes of AMD, if you look at the likes of Nvidia, they've been really good stocks there, especially Nvidia. But Micron has done pretty well this year. But what it has done recently, well, I say this year, a lot of the back end of 2020 into 2021, you can see here that it's done absolutely amazing. You'll see this big massive rally that it had up to about April time. But since then, it's just kind of like gone down a bit, stagnated, gone to $69. It has had a bit of a shoot up over the last kind of 2 months. But even with it shooting up in the last 2 months, this stock compared to a lot of the other semiconductors is like the one that's been left out a little bit. And because it's been left out a little bit, semiconductors are quite hot at the moment, and these guys are still doing very well at the moment. And the big thing is like the valuation on this one compared to a lot of the ones like say, I don't think AMD is too bad, but the likes of Nvidia, does start to get you a little bit interested in this one right now. So you can see here that it's currently a 100 billion market cap company, so it's still a pretty decent sized company. But what the really interesting thing is that it's currently trading down at a 13 times earnings, which stands out as being very different to the likes of like Nvidia or AMD. And the big thing that really stands out after that is that it does pay a bit of a dividend. So you can see here that we have a little bit of a dividend yield here on this one, which is a standout one. Now, like I said, it was early this week in particular. It was one that has been on my watch list probably for the last kind of 1 month, 2 months. Never got around to looking into it, but I thought, you know what, I just try to keep on on top of the news when they do come out. And earnings came out this week. Wrote it down as a one to just check out how earnings do. And earnings were actually really good. They had an EPS beat. They beat on revenue as well. So yeah, good beat from that point of view. Shares were up 5% after the earnings, and also the guidance as well was pretty strong. And you can see there was a massive increase in the revenue, and especially the big thing was the gross margins as well. Was a pretty impressive increase as well. So yeah, really good earnings from these guys. Obviously what did then happen, it did lead the stocks to kind of jump up a little bit. I wouldn't be too surprised if in the short term that does kind of give back some of the gains. We'll see exactly what happens. But yeah, even though it's had a pretty decent kind of couple of months here and has moved in the right direction, looking at this at the moment and what this company could do does still kind of look really interesting to me. Now, if you look here, the company actually historically had a little bit of a slump in growth, and it's just recently started to move back in the right direction. And especially going forward, analysts are predicting the revenue to still carry on double-digit growth, and also the profit to move into a double-digit growth as well, which is pretty good going. So you have revenue increasing, profit increasing, and I'm sure what they'll do with that profit and the very good profit margins they have is increase things like the share buyback, pay more dividends. So a little bit of a dividend stock, but also with a dividend stock you're getting that kind of growth here as well, which is what I really like to pick up. Reminds me of the likes of like a Microsoft, for example. So yeah, very good from that direction, especially when you start working out what this company will be trading at in say 12 months time. Then especially these valuations seem so cheap on this company. Financially as well, the company is very stable. It currently trades at 15% debt to equity as well, which is really strong. It's got quite a decent cash balance. On here you can see that it's got 10 billion in cash and it's a 100 billion market cap company, so that is pretty healthy cash balance here. And you can see they've got 7 billion in debt. So yeah, they've got enough cash to basically wipe off all the debt tomorrow if they really wanted to. Obviously that probably won't happen, but yeah, really strong cash balance. Debt to equity is really strong in this company as well, so financially very sound as well. And you can see here the cash payout for the dividend isn't too much at the moment, but I'm not sure how simply Wall Street correct it actually is, because it does look like recent dividend has been like a new thing for Micron. So yeah, I don't think this is totally correct. As you can see, probably need to, like I said, this isn't me doing too much research on this one as like I normally do. You know, with these sort of stocks, it's kind of like a quick fire 5 stocks, so you're not really like deep dives into them. So I don't have too much knowledge on the company itself here, so maybe do a bit more research than believe what I'm saying here, because like I said, I haven't done too much. But I believe the dividend's quite a new thing for this company here. As you can see, this is the actual Micron history of the dividends. You can see here there's only one payment here and one payment here, so it does look like a very new thing that has come to Micron. Obviously it seems like when you look at the company here compared to, let's just go back onto the share price, you know, the valuations aren't trading anything like an AMD or an Nvidia, for example. So it looks like the company's kind of gone, okay, we're at a cheap valuation, we've got a lot of cash, what shall we do? Let's buy back our shares. And okay, what else shall we do? Oh, let's pay a dividend as well. So it seems like Micron have decided that's what we're going to do going forward, and it looks pretty good. It looks like a stock that you might get some good share price gain on, and also a very good dividend on going forward. So number one is Micron, and this is one that I'm definitely going to do a little bit more research over the next kind of couple of weeks. Number two is a dividend stock. So we actually started talking about this one a bit on the Discord last night, I believe it was. I think it was Matty, who is the Discord celebrity. For everyone that's on the Discord on the Patreon, you know who Matty is. I think it was him that started off the conversation of it all, and he was talking about Foot Locker, and I think it got quite a few of us interested on Discord. Got me interested, got me to write it down as the list of, with Micron, a stock that I really need to do some research on over the next kind of couple of weeks. I always like doing it when it gets to a new year. I really do like looking at a few stocks that I want to buy, you know, some stocks that have been beaten down in like 2021 or the year before, to kind of like start buying in 2022. And this was a really good shout out for Foot Locker. Like I said, a bit more of a dividend stock that you're going to be considering with this one. It is currently a 4 billion market cap. It trades at a P ratio of 4. Don't know how correct that is, because I think they've had a one-time payment that's benefited them, so it is worth checking out that P ratio. But the dividend yield is around about 2.8%, so this is what you would be playing it for mainly, is a dividend stock. But the big thing is that because it has had its share price drop, you might have a bit of a share price gain with this one, and as well as that, you'll also get a high dividend yield as well because of the drop off. So those are things that you'd probably want to consider. But recently it had a pretty decent 2020 and 2021, as you can see. But when it got to May time, as a lot of stocks this year, you know, it's not just the growth stocks, you know, this is a dividend stock. This year has been a bit of an awful year for a certain few stocks out of the big tech, and Foot Locker is one of them. You go from there, the stock is down 31% over the course of this year, as you can see here. And especially if we just zoom out a little bit here, since around about November time, there's definitely been a massive drop off here, as you can see in the share price here. Within just over a month period, we've had a company here that's lost 27% of it. And when you have a company that loses 27% of the value in a month, especially something like a Foot Locker, you're thinking, is that justified, or is this a big massive overreaction? And that's where you tend to get really interested in a stock if this is a good investment. Now, as a typical dividend company, I guess, you know, with these sort of companies, you're not going to have as much growth in these sort of companies, but you want to make sure that you are still being able to pay that dividend. And what you will see here with a company like Foot Locker is they have steadily moved that revenue in the right direction, as well as that the profit is moving in the right direction as well. It's probably better to do it from this point of view. So you can see here the revenue is pretty stable, and you can see here the profit is pretty stable as well over the last few years, and as well as that has moved in the right direction. Now what I'm kind of thinking here is potentially one of the little drop-offs with Foot Locker is that people are a little bit worried about variant. That might be one of the reasons why it's dropped off, because people think, okay, Foot Locker won't have as good sales because of that. And I also think people are a little bit worried about logistic problems with a company like this. Not fully dug into the reason why it's dropped off a lot in value, but that would be my instant reaction off this one right here. And if you look at the financial health of the company as well, it has just recently took a little bit of debt on here, but the balance sheet is still pretty strong, around about 16% debt to equity. And you can just see that debt there. But the actual company itself is currently sitting on a 1.3 billion cash balance, and when you're a 4.2 billion company, that is a very healthy amount of cash balance. So yeah, same again, they've got enough cash if they wanted to pay off all that debt, but they've got plenty of cash here. Profitable company as well, still moving its financials in the right direction. And this is the dividend history of Foot Locker, as you can see. You can see it dropped off for that dividend slightly as the CV situation has happened. But still paying around, it's normally paid around about a 2 to 3% dividend history. So yeah, for you guys that say, yeah, I don't ever cover dividend stocks, there you go. There's 2 dividend stocks there that are very interesting to me. Now that's enough of dividend stocks. Let's go to a growth stock. So next up is a growth stock which is now profitable, which is a stock called Pinterest. Now I've not really bought any Pinterest for about 2 years now, so it's been a while since I've bought some Pinterest. Look how much I've been searching dividends. It's actually come up now, pin stock dividend. Be a while before these guys pay a dividend. But yeah, I've been a bit shareholder for Pinterest for a very long time. I originally got interested when it dropped off on its IPO, and when it started dropping off of its IPO, I thought, okay, let's pick up some shares. And since then, the stock moved in the right direction, and I sold a good half of my position in Pinterest for about a 200-300% return, which has been absolutely amazing. Since then, the share price has moved in the wrong direction, and since highs, you can see here that we're down. Well, we've lost nearly over half the share price value in the last year on Pinterest. Now, the big thing with Pinterest is it's a 24 billion market cap company, currently a 69p ratio company. And Pinterest is a social media website, but it doesn't have that kind of element of a Facebook, for example, or an Instagram, where it's a little bit controversial. It's a very safer platform where there's not as much controversy. And in general, it seems like a bit more alternative to like the likes of Facebook and Instagram. And I think it's a little bit sticky from that point of view, you know, it's a little bit different from them social medias and holds its own in that kind of social media space. You know, normally Facebook are the ones that have a monopoly over here, but obviously Pinterest has proven that they are around to stay for a while and have made the platform very successful. Now, the big thing is the share price is moving in the wrong direction, but when you actually look at the financials here, look at these financials, the EPS, beat, absolutely amazing. Revenue, beat as well. And look at the growth here. This is a company that benefited from the CV situation, which you can kind of see in the share price. It's done absolutely amazing. But the big thing here is this company's grown 43% year over year, and this company had very hard comparisons to beat. So you probably look at this going, okay, EPS is beating, revenue's beating, it's growing 43% year over year, even with very hard comparisons to beat. What's kind of going on here? Why is the share price losing half its value this year? Well, the reason why is because the monthly active users are not growing as quick. Now, obviously, when you take that into consideration, everyone's been stuck at home. Year on, is everyone stuck at home? Not as much. So obviously, the monthly active users will drop slightly. The big thing is not to have a drop off where you lose half your monthly active users, I guess. But they're still slowly moving in the right direction, but not bad to say you've had a very hard comparisons where everyone's been at home. So I personally, for me, I'm not too bothered that the monthly active users is just slowing down. That's just normal from my point of view, but it's how much they carry on improving the platform, making more revenue from the users they do have, the users they've gained, and as well as that, they're increasing the profitability of the platform, because Pinterest was not very much a monetized platform only a couple of years ago. The US side of it has been increasing a fair bit, but the big part of the Pinterest platform is the international. International, as you can see here, international is where the growth is for this company, and that's where the users are coming from, and also that's the part of the company that's hardly been monetized. Now, what Pinterest has started to do is monetize the international side of the platform, and because of that, you've seen the revenue grow, you've seen it becoming more and more profitable. So even though the users are dropping slightly, which I'm not really bothered about, over the long term, obviously you want to see that move back in the right direction, but I thought, you know, generally that was what was going to happen. The company loses half its value, but every other metric in the company is just getting better and better, and you're thinking, okay, this is an absolute steal right now. And the big thing here is if you look at the financials, you can just see the amount of revenue growth that's here. The company is now profitability, and the profit they're making is absolutely amazing. Financially, health-wise, a really good company on the financial health, no debt on there, very good debt to equity. Quite a fair bit of cash on there. They had a bit of cash beforehand, but now they're making profit. Obviously, some of that is going to the balance sheet as well. And also, it's a founder-led company as well, and still has a major holding in the company as well, which is obviously a bit of a positive. So, number 3 is Pinterest. Number 4 is a company I've talked about, I think, once before, which is Fiverr. So, at some point, I think Fiverr does come and buy. I still struggle a little bit with the valuation point of view, but it's really coming down in the valuation. It's one of those where you, at one point, where'd you go, okay, this is now a buy. So the share price went on a crazy run in 2021. They do a freelance services. So basically you can go out on this Fiverr and say, this is what I do. Businesses come to you that don't want to have someone full time but need someone to do that work for them. So for me, for example, I could get someone to come and do my thumbnails or someone to edit my videos. Don't need them all the time, but I say, hey, can you, edit this video for me? Here you go, pay it. There you go. The Fiverr platform is absolutely amazing, and I think the freelance economy is going to just carry on growing, and has also been sped up because of the CV situation. Now, obviously, people realise that this will do well in 2020, and the share price went absolutely insane, and went up 1,000% in 1 year. But what's happened since then is that it's peaked all the way up at $300, and since then it's just been going lower and lower and lower. And even right now, when a lot of stocks are slowly starting to put a bit of a bounce in, this has just gone even lower over the last kind of couple of months. You broke through that $200 range and now down at the 117. So I mean, this might go from triple digits down to double digits on the share price, which once again you're kind of thinking, some point this comes by when it keeps losing this amount of value. Now I think this is one that you justify that it deserves a pullback. It was a crazy valuation. But at some point where you go, this is a fantastic company and it's losing a lot of its value here, it's going to be a buy. And that's what I'm looking at Fiverr in particular. Now, once again, this company had very hard comparisons to beat, but went from 52 million to 74 million. Still very good growth with very hard comparisons to beat because of last year. Now, the great thing about this company is that it's currently not making profit, but the cost of revenue and the gross profit is really good. So if it didn't really invest a lot more into its company, it could be profitable, but it's focusing on growth, is trying to beat the competition, which really is up work. And you'll see here that the revenue is 74 million, but it only costs 12 million. So the gross profit is 61 million, which is pretty good. And you'll see here a lot of that cost goes into research and development, and one of the big ones is sales and marketing. I mean, that's nearly pushing 40 million. So, you consider there that if you do knock off some sales and marketing, very easily this starts to talk about becoming a profitable company. But one of those, do you want it to kind of just sit there and not grow? Do you want to lose to the competition? Or do you want to come and take a lot of market share and become a big company and benefit from that in the long run? And I think that's what Fiverr are doing, and that's what you would probably prefer them to do. So yeah, even though it's losing money, it could easily be a very good profitable business model, as you can see from here. So I'm a fan of it because of that reason, and also because I think it's going to be massive growth over the next few years. Financial health wise, maybe not as solid as the last couple of ones that we've had. You can see here that there's been a shoot up of a debt taken on here, so the debt to equity is a little high here, but he's still sitting on a fair amount of cash here, so won't worry about it too much, but maybe not as strong as what it used to be, but still okay, but worth shouting that one out, I think. And you can see here, it's still a fair bit of ownership on the inside, and founder-led as well, which is pretty good going. And we're on to number 5, which is the last one, which is Roku. So this is one that I've never really been interested in because the valuation has just been absolutely crazy. But nowadays, the valuation is starting to drop on this one. And once again, it'll be some point when some people start coming in and buying some Roku. So you'll see here that it peaked out at July time, $468. It lost half its value, as a lot of growth stocks have. Now down at 31 billion, 111p ratio. And on historic metrics now, you can see that it's starting to get back to its normal kind of metrics that it used to trade at. So you can see here that it was kind of peaking around the kind of double figure mark, and now we're back down at 8. So it's starting to get there. I think it's still a little bit high for me to buy, but it's definitely one to kind of get interested in because it's lost so much value. And Roku is historically a very good revenue company, growing in the right direction, starting to make profit now, and that profit should move as well in the right direction. So that valuation, it's halved, and then you factor in the growth that will come up in the future. Does kind of get interesting with this one. And financial health wise, once again, very strong on the balance sheet. No debt on there, sitting on 2 billion cash, which is pretty good going. And once again, you have a founder-led company, and he also owns 12% of the company as well, which is great. So yeah, not sure on Roku yet myself, but I can definitely see a few people looking at this one going, okay, it's a great company, it grows a huge amount, it's lost half its value now, the metrics are a lot cheaper. Do I take a punt on this one? Potentially. For me, I'm not too sure on it. For myself, I think I would still like this to come down a little bit cheaper, but at some point, people will buy it because it's a fantastic company at half its value. So definitely want to add on to a watch list, and maybe just keep an eye on at some point. And it's definitely one I'll keep a track on, because if this sideways for a couple of months or goes even lower, you never know what will happen anyway. So yeah, hope you enjoyed it. If you could, hit the like button. If you're new, subscribe, and I'll see you on the next video.